Most investors think wealth is built by finding the next big deal, but that's a lie. The world's wealthiest families don't chase deals, they allocate capital. And if you don't shift your mindset, you'll spend your whole life chasing opportunities, while truly wealthy families are quietly building empires that last for generations. By the end of this video, you'll know why deal hunting is a trap that destroys wealth, the three-tier capital allocation system that wealthy families use, and how to instantly filter out bad deals and focus on long-term winners. I'll give you a bonus with the real estate diamond framework, the same tool used by institutional investors and Infinity. And finally, the key psychological traps that cause even smart investors to make dumb decisions. If you're serious about playing the game at the highest level, this is your blueprint. So let's get into it. Let's start with a harsh truth. Most investors will never build generational wealth. Why? Because they focus on hunting deals instead of allocating capital strategically. Here's how the trap works. One, it's called the great deal syndrome, where investors believe the one amazing deal will set them up for life. Two, emotional attachment. They fall in love with the deal without considering how it fits into their broader wealth plan. And three, over leveraging, where they take on too much debt or risk to make the deal happen. Four, no exit strategy. They don't consider what happens if the market shifts, interest rates rise, or the property underperforms. Five, rinse and repeat. They do this over and over, creating random portfolio instead of a structured one. If this sounds familiar, you're not alone. I once knew a guy who had about $100 million in real estate assets. He was great at finding deals, but had zero capital allocation strategy. His portfolio was a mess. He had value-add multifamily, he had ground-up development, short-term rentals, opportunistic flips, and a few like random industrial and office plays. What happened? His cash flow was messy, or a mess. He was asset rich but very cash poor. He had way too much leverage, so when the market turned, he basically got wiped out. He had no liquidity strategy, so he had to sell the best assets at the worst time. In less than 3 years, his empire collapsed. Why? Because he was playing checkers, while wealthy families were playing chess. Now let's contrast that with how wealthy families actually build long-term wealth. Before they even look at deals, they step back and ask, how much capital do I actually have to invest? What percentage should go into real estate, private equity, public markets, and other alternatives? Within real estate, how much should be in like core assets versus growth or opportunistic? What is our risk tolerance, liquidity needs, and long-term generational goals? They define their allocation strategy first, then go hunting for deals. This is the game changer. Let's break it down exactly how they do it. Family offices divide their real estate investments into 3 categories. One, which is called the core. It's for wealth preservation. It's the foundation of generational wealth. Think high quality, income producing assets that are fully stabilized properties, Class A tenants or locations with long-term leases. Think lower risk, steady returns, and hedge against inflation. For example, a portfolio of institutional grade multifamily properties in major cities with strong rental demand. The target allocation is usually 50 to 70% of the real estate portfolio. This might depend if on their journey as a family office. If they're starting, it might be less. Why it works? It provides predictable income and acts as a hedge against economic downturns. The second portion is called growth, which is capital appreciation and value add strategies. And this is called like the wealth multiplier. It's slightly higher risk, but controlled upside. Development projects, value add, renovation, repositioning assets. The goal is to buy at a discount, increase value, and create forced appreciation. For example, buying an older apartment complex, upgrading the interiors, and raising rents. The target allocation for this might be between 20 and 40% of the real estate portfolio. And why does this work? Because it captures appreciation while still providing a stable asset base. And the third portion, which is the smallest portion, is the opportunistic. It's the high risk, high reward, the speculative bet. And here you have ground up developments, distressed assets, unique market plays that have high potential returns but require deep expertise. They must be carefully sized to avoid overexposure. For example, investing in an emerging market before it becomes mainstream. The target allocation for this should be between maybe 5 to 15% of the real estate portfolio. And why does this one work? Because it creates massive upside potential while keeping the risk controlled. The key? The allocation comes first. The deal comes second. Now that you know where deals should fit in your portfolio, let's talk about how to evaluate them properly. I use the real estate diamond framework, which is also called the building capital framework. And it's something that we coined in Infinity 9 to analyze every investment from 4 critical angles. Imagine a diamond. You have the product, which is the physical asset, and the value add potential. What's the condition, functionality, and competitive position of the property? Can I increase the value through renovations or operational improvements? The second part of the diamond is the market, economic, supply, and demand analysis. Is this a property in a growing or declining market? What's the local demand, competitive landscape, and economic outlook? The third is the finance, which is also the capital stack and risk management. What is the capital structure? The debt, the equity, mezzanine, etc. Can the deal survive interest rate hikes or economic downturns? How am I protected? And fourth, which is maybe the most important, is people, management, and stakeholder alignment. Who are the partners, managers, and key players involved? Are all the stakeholders aligned on risk, exit strategy, and incentives? If a deal fails in one or more of these areas, it's a pass. This 4-sided framework ensures that you don't get blind by the hype, but you make good decisions. Most investors chase random deals and hope for the best. The wealthiest families, they use a disciplined framework. If a deal scores well across all 4 dimensions, it's a go. If it's weak in one or more areas, it's a pass. Which type of investor do you want to be? If you found this valuable, drop a comment below. Let's talk about how you can build wealth the right way. Now, are you ready to think like an asset allocator instead of a deal hunter?